presentation. I mean, it was a lovely presentation with a lot of insights. So now for the panel discussion, I would be liking to invite our guests. I would be liking to invite Mr. Bhavesh Gupta, who's the current CEO of lending at Paytm. Along with him, I would also be liking to invite Mr. Nitin Gupta, who's the founder and CEO at Uni. And as the moderator, I would like to invite Priyanka Iyer, who's currently the senior correspondent at Money Control. Thank you so much, guys.
Thanks a lot for that, Samar. Thanks, Nitin and Bhavesh. This is going to be really interesting because of the immense amount of experience that you both get into a space which is not exactly new age, but is really evolving in the past 1 year or so. So, my first question is to both of you all. Really, you all have been with, Bhavesh, you've been with some of the best banks in the country. Nitin, you founded PayU, that was years ago. You've been with Ola. How have you all seen this entire space of how customers are borrowing really changing in the past 1.5 years or so? EMI or BNPL are not really fully new concepts. We've seen Bajaj doing that since a while. But really, how have you seen customer behavior change? Bhavesh, maybe you can start.
Sure. Thank you, Priyanka. Hi, Nitin.
Hey.
So look, the way things have changed is at two levels. And I'll say before the global financial crisis, when there was no credit bureau, etc., I think the industry had more appetite, and they were going ahead and creating the business opportunity. Post global financial crisis, bank became very conservative. Two things happened. One piece was clearly that you found better credit, or people with better credit getting more credit. And there was an exclusion of people who either did not have access to credit or did not have good credit history getting excluded, and which resulted in various other business models evolved in, namely gold loan, microfinance, so-called fintechs, etc., etc. So there was an exclusion of people or borrowers from the formal economy or formal banking system. It led to these business model emerge. So that has been the one big thing which has happened. This has interestingly got further augmented by technology, wherein the catch-up that the traditional players were supposed to do on technology did not do on technology. So even people and consumers who were very happily okay to get included in banking credit domain actually gravitated towards more technology-led domains, which came in through fintechs, because they found the customer experience that they were getting used to with Amazon and Flipkart, similar experience they were hoping to get from somebody, and fintechs had to provide those experiences, which were first with UI UX and then became with products, namely BNPL. And that shift has now started to become a wave, and is no more that it is an isolated incident. I think it is becoming a wave now.
Right, Nitin. So how have you seen users behave? I mean, what you're offering is one of the newest kind of offerings that the BNPL space has. So tell us about your experience in the past year with how customers are reacting to such products.
Right. So Priyanka, first of all, hi everyone, and thanks for having me over. Hi Priyanka. Hi Bhavesh.
Hi.
I think I agree with what Bhavesh said, but I'm going to give a very different perspective. I think what has changed in the last few years is the type of payment products which are credit backed. So there are two types of payment products which are credit backed, which have been very popular for a long time. One is credit cards, and other is this 0% EMI, the BNPL, but started by Bajaj Finance in 2007, where you could walk into a Chroma, buy a Samsung fridge for 12 months, 0% EMI. I think what has happened in the last 2-3 years is that there is a shifting trend of new types of payment instruments. One type of payment instrument was this product where you're buying very often on big baskets, Swiggy, Zomato, Ola, Uber, and you could do those transactions on a postpaid or a simple or a lazy pay and pay back 15 days later. Right? A product very, very squarely targeted towards convenience, so that you don't have to enter an OTP or a password or whatever. Right? Then came companies like Uni, where last year we launched a product which, on top of a Visa card, allows you to do every transaction paid in 3 parts over 3 months at 0 cost. So earlier, your 0% EMIs would work on very specific stores, And today, Bajaj Finance has the maximum or largest such network, but it's still 100,000 stores. But by launching a 3-month 0% EMI, or paying 3 over 3 months at zero charge, running over a Visa card, suddenly this proposition was available at over 6 million merchants, right? So that has been game changing in some ways, and consumers have been shifting from other payment instruments, credit card type of payment instruments, to these type of payment instruments that Uni and others are building.
I think Nitin's network has some issues there. I'll move on to the next question. We'll go back to Nitin. Bhavesh, just trying to understand, when you look at models like Nitin's, when you see Uni, and in comparison to what Paytm is offering in terms of lending, really, is there a difference in the customer base that we are looking at, or is it the same customer which is looking at all forms of really models that are coming towards the way?
So Priyanka, I think the customer is not different. It is basically the core difference between, let's say, Paytm and what Uni is doing and others is doing is that what rails are you using to distribute these products, right? Paytm, being a payments company, has its own rail. Right? We are a two-sided ecosystem. So we have consumers on one side and merchant on the other side. We have our own rail that we created for our wallets business, etc., etc. And because we have our own rail, we're able to put credit instruments on that rail. People who do not have that rail use other people's rail, namely Visa, Master, and I'm sure tomorrow it could be UPI. So the product delivery is on different rails, but the customer is the same. And customer is choosing either the product which fits their thinking better, or the product which is offering a better experience. And I think that's the fight which is out there in the market. Everything else remains the same.
Right. Nitin, you can finish. We lost you in the middle.
Sorry, there was a power issue at my end. No, so what I was saying is that one of the other things that has started to change in the last 2-3 years is that the number of customers who could earlier access a 0% EMI from a traditional institution like Bajaj was limited. If you go talk to Apple, they'll say that my biggest problem was, how do I get more customers get that 0% EMI loan? And therefore, companies like Zest Money, Paytm, etc., have just helped expand that bucket too, where customers who did not have access to a 0% EMI at a store, instead of that solution being available but not getting it, new age companies have been solving that. So these are some changing trends that I am seeing.
So I was asking Bhavesh whether the customer that he serves through Paytm or you serve through a new product, are they different? So in his opinion, they're pretty much the same customer. But how do you have to, is there a challenge in positioning yourself and explaining to the customer what really you're trying to offer? It's not just EMI, it's not just BNPL, but it's a card. So it allows you to have a physical presence as well, but you can do it digitally. So is that challenge there for companies like Uni, Slice, LazyPay, even they have also come out with a card product?
I think at least I'm not feeling that challenge. One of the things that some of the erstwhile players tried to do was position this buy now pay later product as a credit card product, and I think that was really wrong. Right? We are very clearly buy now pay later running on top of Visa rails, so it's a pay later card, new type of category, but it is definitely not a credit card, right? But as soon as you explain a customer that it's a payment product, works on Visa, backed by credit, this is how credit works, this is how reward works, I think customer gets it. So at least we haven't faced that challenge at all in being able to tell a customer of what this product is, what Uni is about.
Bhavesh, if you can give us your views on really how this space will really evolve going forward. There are smaller ticket sizes which are really picking up. So that is one of the things that is happening. Apart from that, younger people are taking more credit because they think they can repay that sort of amount. But really, how will it evolve going forward as fintechs keep coming at the forefront of this entire lending space in India?
So Priyanka, I see a couple of things play out very clearly. One piece which is going to play out is that, unfortunately, credit card penetration in India has been very poor. And the reason for credit card penetration being poor, both is a issuer side problem and an acquirer side problem. Issuer side, obviously, it's a risk issue. So you issued 50 million cards on a population technically which is so large. And on the acquiring side, the people who can use a credit card, the places it's a limited infrastructure, maybe about 3.5-4 million shops in which you have a point of sale device and now online. So one of the biggest shift that we are clearly seeing here is that there is a very large population of customers who want a payment credit instrument, right? But they don't get one. So first change is happening here is that because now credit is on mobile, in digital credit, the cost of giving credit, not the cost of risk, just cost of giving credit has dropped significantly. And hence you can afford to give very small bite credit, $500, $1,000, $2,000, which is not possible in a credit card situation because there's a cost of plastic, delivery, management, and all the good stuff. So the first big trend here is that credit has to move and will move from a form factor called plastic to mobile, just like payments have moved. The second thing here is that on the acquiring side, it will become device agnostic. So the infrastructure will have to become device agnostic, wherein credit can be disseminated through mobile, either on a physical device through tap and pay, or on a QR rail or any other wallet rails, which basically means that the extent to which people can use credit at a shop will expand disproportionately, right? Like in Paytm Postpaid, we know that you can use it at millions of places, but you cannot use the same thing on a credit card, theoretically, right? In tier 2, tier 3, tier 4, technically, wherever payment QR is available, you can use that very effectively. So that's a big change, which basically means it'll democratize and will bring in many more people who will start imagining and taking credit to do consumption or lifestyle purchases. And number 3 piece here is there will be a lot of transparency, because today, for whatever we may say, a credit card has remained a bit of an opaque product, right? That if I don't pay, then what happens, etc., etc., etc. There is very limited flexibility. The products of the future and the big trend will be, they will be more transparent because they'll be on the phone. You cannot show terms and conditions on a credit card, but you can show everything on the phone, right? Whatever I want to do, I can communicate to you on an Android device and say, hey, you know what, you're getting into 1, 2, 3, 4, 5, 6, 7. I think, do you like this? Do you want to change this? Do you want to do everything else? So there is a lot more transparency and flexibility which will come in products, which is not in the plastic. And that's the reason we have very clearly been focused in saying we would like to be mobile credit led, BNPL or whatever you want to call it, and not plastic led, and leverage our own rail. And that's a shift that we see. But for some time, both will run. Right. And then
I was just going to come to that. Yeah. Because, like companies like Unislice, they all are going back to giving people what they want online as well. At the same time, you have a card to support it. So is that going to be, Bhavesh, in your view, something that will go on for a while until customers can fully go digital?
So this is digital. It's just a form factor is a plastic. And the reason for that here is, unfortunately, today, there is no universal rail on which credit can be given currently. Right, so you have Visa rail, MasterCard, Amex, UPI, and obviously there are captive rails which are like Paytm and wallets, etc., etc. There will be a point in time, hopefully, when you could have a universal rail on which credit can fly, which basically means form factor will go away. So form factor, in my opinion, today is of a plastic, is more coming out of compulsion that you have to ride a rail, not because this is the right product for the customer. Ideally, and it will become very, 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 very common. As tokenization on cards have come in, right? These plastics will also be tokenized on a phone. So when you're going into the market, you will not need to flip out a Uni card or a Slice card or any other bank card. They're tokenized on your phone and you can tap and pay and actually do the same thing, right? So that is actually going to happen. Yeah. That's a big bet which is there. So form factor is not a plastic.
Yeah, Nitin, you want to comment on that?
I have a slightly different view here from this, right? I think this is already happening. See, I think there are 2 trends you will see in the near future. First is UPI adoption by every credit player. I think in the next 12 months, if not much earlier than that, you will see that every credit card app, you can open up the app, scan a QR code, make the payment, and the money gets debited to your credit line, right? So, and while Visa, MasterCard rails may be limited, UPI rails is far more ubiquitous, right? So that's one thing which is definitely going to happen. The second thing which I feel will also happen is that, see, why is today a credit card not able to ride on Paytm rails anymore? because Paytm charges a 2% convenience fee for a credit card. I think that thing will also get solved. I think right now, Paytm says, dude, you're charging me a very high, a fee, I interchange to load money into my wallet. I don't want to pay that. At the same time, they're missing out on Paytm's, own rails. I think a solution will emerge there sooner than later. So I feel that it's a matter of time when the rails are highly usable, right? Whether it's a credit card rail, Paytm's own rails, or a UPI rail. I think rails is not the limiting factor, will be the limiting factor or will matter in the next 12 months. What will matter is who can give the customer the most appropriate credit line. And the most appropriate credit line is a function of price, line size, features, value proposition, such things. And that is where the game will lie. I don't think it's an acquiring first game. I think it's an issuing first game.
And so as interoperability will kick in, I guess that will pretty much, you are
Exactly.
saying, take the backseat. Got it.
So right now, interoperability still exists, right? Between a credit card and a Paytm wallet. The only concern is the 2% loading charges, right? I'm saying interesting solves will also emerge around those.
So I guess good for the customer, but let's see how it works out for businesses in that case. If you all can also really throw a light on how exactly India's model will be, trajectory rather, will be different from what's happening globally. Everybody's spoken about how we're jumping from credit cards to completely going digital when it comes to taking credit. But really going forward in the next 5-10 years, how will this space evolve overall, and from both ways, from the customer and acceptability point of view, as well as for startups, for companies? How is it going to be different really to continue in this space with Indian customers?
The way I see this piece, Priyanka, is, and it's great that you asked this question. So India has been, unfortunately, significantly behind in credit and credit penetration to population, right? Versus any other economy that you look around. So in the US, people have more than 2 cards. In India, you don't just have cards. And hence, when you look at BNPL or any other innovation happening there, it is actually more leverage being given to already leveraged customer. Here, you're not giving more leverage to a leveraged customer. You're just giving the first leverage in all probability to a customer because the person has never been able to borrow. So that's a one big change that is going to happen. That, in my personal opinion, the global models that we talk about are focusing on giving more leverage and getting very high premium products under this so-called BNPL credit line. Whereas in India, it will happen that some more leverage is given, but a lot more is being given to first-time borrowers for consumption credit, which ideally should have been given to credit cards if credit cards were like omnipresent in the country as it's been in the European markets. The second thing here is India is far ahead on payments. So India arguably is number 1 on payments in terms of infrastructure. So the innovation will happen on top of payments, which is top of digital payments. And as Nitin said, that the credit element is going to be solved more and more differently by different people, looking at different kinds of data, because the data is now available of payments to most of people, be it banks or fintech. And hence that innovation will happen. But the delivery will be far different in India because of the payment rails India has, which the West does not have. So you don't have to really solve for those problems. You will solve for credit dissemination problems and acquiring side problems. And that is where the innovation will come in. And my personal sense here is that the regulator has been in the forefront of making some material changes, and hopefully the digital lending guidelines, which are in the works as 2.0, will further augment this entire process of getting more and more consumers get formal credit, maybe through BNPL or any other means, which has generally not been the case in the past.
We'll get back to the point on regulations, but Nitin, how do you see this space evolving? And also, if you can give your 2 cents on really, do you think that so many players, will that be sustainable going forward? Will we see consolidation very soon?
See, on the first question first, right? There are two supporting things we'll need for the credit to grow, right? One, we will need more data to underwrite customers better, right? And today, the digital footprint of customers is just exploding. So you will see many non-lending players unlock their data. So see, financial services data is anyway getting unlocked through account aggregator. But non-lending players will unlock that data for a fee. That will be a big trend. Telcos already do that. You'll see many more players do that. And therefore, data will increasingly become commoditized. Second thing that we need to do more credit is scale balance sheets in near prime and subprime books. So today, scaled balance sheets primarily exist in super prime and prime books. But the next set of customers who are coming in, right, they're not just super prime and prime. They will also be near prime and subprime. And today, near prime, subprime scaled liabilities don't exist. Those institutions don't exist. So we will need support on the near prime, subprime liability side too for this to happen. So I see those two trends also happening for this credit journey to, or this credit explosion to happen.
Right.
On consolidation, see, I believe that in this business, right, in a lending business, there is inherent unit economics. That's not the problem. The problem is customer acquisition cost. Now, either you are a large platform like Paytm, which can cross-sell to its own customers, or you are somebody like Uni who builds so innovative products that the customer acquisition cost comes down, right? But what you have seen happen in personal loans, the economics have gone for a toss for every digital personal loan player just because the customer acquisition cost has gone through the roof. It's a commodity product. And because it is a commodity product, if you're a digital lender, your CAC is really too high for the business to make sense, right? The same thing will happen in credit line products too, in payment-led credit products too. So either you are innovating so well, your product is so much ahead that people want your product, your brand is so strong, or you are cross-selling. Everybody else will not be able to scale. So I don't think this will be a game where there'll be hundreds of brands. Just like in credit card space, you see 4 or 5 brands dominating with 70-80% market share. I feel even in the BNPL space, you will have a handful of brands dominating in the space because of these reasons.
Got it. And of course, you spoke about how we really need to build on the subprime customers. The focus is also on a lot of new to credit customers. So of course, there is this clear worry from RBI side also is about NPAs. How do you see in the beginning? Of course, there's going to be that risk. You're getting customers who you have had no data on as well onto the platforms. How will that really pan out in the next few years? Will it interfere the amount of NPAs? Will that interfere with what RBI is looking at? Will that thwart innovation? Or do we think that that's going to be a temporary thing and then probably going forward, we'll have better data on a lot of new customers? Bhavesh, maybe you can start and Nitin, you can.
I think the important part to understand the distinction between subprime and new to credit. New to credit is not subprime. New to credit is somebody who's not taking credit. Doesn't mean the customer is bad. Subprime is typically people who are over leveraged. I'm talking about the real definition of subprime, which is known in globally around the world. They're over leveraged and they may have been defaulted, etc. I don't think that there is a lot of credit to be given in India today to over leverage people. Well, there is some bit, but there's a very, very large population of people which is to be given credit who have never taken credit, especially self-employed. See, salaried credit is easiest to give and every bank is very happy to give. The self-employed generally doesn't get credit. Forget about BNPL. They don't get credit even for working capital, right? So the way I see this piece here is that the so-called NPA problem will be not as high as it's made out to be. Yeah, there are certain people and players who may be doing business not so correctly, but at a larger level, right? At a larger level, thanks to credit bureaus, thanks to data now being available, thanks to GST, thanks to multitude of information available to you. And I can say from a Paytm perspective, what kind of information is available. Unless and until you are reckless, there is no way that you can get into any kind of material NPA issues, right? Which can either be of a consequence that your business is not viable, or somebody in the regulation could very clearly worry about. And this has been seen in microfinance. It has been seen obviously now in consumer credit, etc. And there will be maybe a blip to begin with, but I think incrementally, and I can see this over the last 4-5 years, incrementally, even the borrowers are getting more smarter and intelligent that they shouldn't be defaulting because they know the impact of this is going to be very, very catastrophic in their ability to borrow in the future. And the new age borrower wants to keep borrowing. I don't think this is an issue. The issue is going to be that more and more players coming into the game will put stress on unit economics. And when you put stress on unit economics, and for players who are wanting to lend on their balance sheet, and or players who are wanting to build a business which is fairly wafer thin, the cost of capital will become an impediment. Because to get cost of capital for such a business in India still is going to be very expensive. And hence, if you are now lending very expensive, you will not be able to scale. If you're lending not very expensive, but fairly cheap, then you will not be able to make money. That equation will have to come into play very, very clear. And that's the reason Paytm has been very clear and focused in saying we would like to partner, because we would like the banks and our non-banks to take the risk, give their capital, and we will bring technology and customer experience and the acquiring side and make money on that part. And that model has been very, very helpful and scalable for us.
Yeah, I guess that's the model that most companies are really looking at. Mrigank is here, so we don't have much time. But Nitin, if you can just give your 2 cents on really how regulation will really change the space and how NPAs will really be a concern or not.
See, on regulation, I think the good thing about India is that most BNPLs are regulated. They are barring 1 or 2, like literally 1 or 2. Everybody is regulated or is working with a regulated partner, right? So unlike across the world, BNPL in India is regulated. So I'm happy about that. And if RBI puts in more regulation, I don't think it needs more regulation, but if it does, to clarify things, it's only good. So being regulated is a good idea, first of all. I'm very, very supportive of that. From an NPA point of view, see, that's what I said, right? If you're looking at just NPA, you're assuming your revenues are constrained. When you're looking at a super prime book, your NPAs have to be tiny for you to make money, right? In fact, tinier in super prime, a little bit more in prime. And that's my whole thesis, that at least in the West, there is something called risk-based pricing. If your NPAs are high, you also make more money. And that's true in India as well. If you look at the personal loan industry and the microfinance industry, in microfinance, your NPAs are higher than your salaried PL. And therefore, the take rates or the interest rates being charged in microfinance is meaningfully higher. Today, people get personal loan anything from 10% to 15% to 20% to 30%, depending upon their risk. So NPAs have to be seen with respect to the pricing being charged. Right? Now, there are some fair pricing, right? You cannot charge more than this. Now, within that, if the NPAs are landing well and make sense, overall economics of the product lands well, very cool. But if NPAs are looked at independently or NPAs are so much that the economics are not holding up, then it's pretty bad, right? So I view NPA with the lens of revenue, and therefore which segment you're operating in, and therefore the economics in that segment is holding well or not.
All right, thank you both of you. Mrigank, over to you.
Yeah, so just maybe one last question in the last 3-4 buffer minutes we have, Bhavesh and Nitin. So I think one stakeholder we didn't speak about was the merchant side of things. So, when the platform tries to reach, we talked about use cases in the presentation as well. What has been your experience when trying to convince or the merchants to sort of adopt these the new age payment solutions, and what is the receptiveness like? Are there some things that need to be solved for? So yeah, a very brief answer from Bhavesh and Nitin will be helpful here, just that the merchant side of the story.
I think very honestly, consumption credit or so-called BNPL as we're calling about it, this game is about acquiring. This will not be a game about issuance, because the scale will come in acquiring. Merchant has to accept it for it to move forward, right? And it has to accept it. I think the way we've been seeing this piece, it is that the merchants are damn happy to get any instrument which can give them credit, because affordability is important, and affordability is important at every level, even for a very small ticket item. Even for a pawn shop guy who actually ends up giving credit to somebody and saying, you can pay me end of the month, if there is credit available to the person, he enjoys it. The issue here is the maturity of the merchant to understand the cost of getting their acceptance of credit, right? Because they are, in their minds, not okay to pay 2% MDR, which credit card companies are used to charging, right? I think this chasm is going to be crossed over a period of time, when more and more awareness will start happening in the minds of smaller merchant, not the larger merchant that we're all used to, going down to a Flipkart and Amazon or Shopper Stop. Yeah, those are getting sorted. But the actual scale will come when you're going down to the smallest shop, where there can be a credit given to the person and it can be converted to installments or a 30-day product, etc., etc. I think that part is something which will take some more time for the acceptance to happen. And to that extent, people and companies who can invest on merchant acquiring infrastructure without hoping to get some revenues out of that infrastructure will win the battle eventually in the system. That's what we are actually aiming for.
And I have exactly opposite view. I just don't think this is going to be acquiring first stop. There is an opportunity with merchants to monetize them more, but I think that opportunity is too small and too effort taking. So I will let Bhavesh solve that problem. I'll focus on my issuing side. I think this is issuing side first problem, and there are payment networks, whether UPI or Visa, MasterCard, or for that matter, Paytm, right? Where who you can leverage to build the issuing side out.
Thanks, Nitin. Thanks, Bhavesh. I think obviously it's just a small tip of the iceberg of a very complex, larger debate. So we'll probably take it up in another forum. But yeah, it's been absolutely fantastic having Bhavesh, you and Nitin to share your insights, and Priyanka, thanks for the moderation. So with that, I'll hand it over to the team. Yeah. So yeah.
Thank you. Bye-bye.
Thank you so much, panelists, for that lovely session. It was really insightful for all of us here.
Thank you.